The beginning of the last breaking news of the week, and of course, this is our third look at third quarter GDP. Last look, 2.1, unchanged, remains at 2.1, holds on to the 2% plus handle. Consumption, a big driver, obviously, of the U.S. economy. 3.2. Now, this really is a jump. We went from 2.9 to 3.2 on consumption. That's very good news. The price index, all lateral, based on expectations and rear view mirror, 1.8 on all three. And finally, the personal consumption expenditure quarter over quarter up 2.1. Same as the price index, 2.1 in the front windshield and in the back. All things considered, this is a very solid number. We don't expect the third revision to have huge movement. We're still above 190 and a 10, but if you really want to break the notion of the recent double top, we have to close above 195. A weekly close would be powerful. Witching, a big topic today in the equity markets. And, of course, the dollar index looks like it's coming into another positive day. We'll still have personal income and spending and University of Michigan coming up. Becky, back to you.
No.
Rick, stick around. Steve Liesman's here, too. He's got more thoughts on some of these numbers that are just out. What do you think?
I don't have a whole lot of thoughts, Becky. It's broadly and widely unchanged. I was trying to figure out, Rick's right to flag that consumer number doing a little better. Also, business investment structures and equipment all did a little less worse than originally reported, except for the intellectual property and software. That was a little bit worse than originally reported, which is how you end up unchanged, but and state and local. But if I could just get to Jason, he's got an interesting idea here. That this is the state bottom here. We've troughed out in terms of this slowdown from 3 to 2 we had in 2019. And what is it, first quarter of the 2020 you think is the bottom?
Yeah, for the U.S. I think actually global growth probably bottomed. If you look at the Bloomberg or Citigroup economic surprise indices, those bottomed in August. I think the market's been telegraphing that. To me, the big weakness in 2019 was largely, it was due to the trade war, but not because our trade deficit widened dramatically. It was largely because it hit business confidence and capital spending. Capital spending was very strong.
Let me give you some numbers here. Equipment spending minus 3.8 in the third quarter. Business structures minus 9.9, minus 2.3 overall on business investment. That number you think comes back?
To me, CapEx comes back next in 2020 because the tax cut was a very supply-side oriented tax cut meant to stimulate capital spending. It did last year. It didn't this year, but I think there's some people like Larry Summers and Paul Krugman and others are counting it out, saying it was a sugar high. In my opinion, it's not a sugar high. As once you got phase one done, in my opinion, CapEx should come back in 2020.
Is that a story for the second half? Because what I've heard a bunch of economists say is you've done some damage to the psyche, to the uncertainty, with the uncertainty with the business investment, and that's got to play out through the first half. You don't have business change on a dime like that, but in the second half you could see the
result. Yeah, maybe. I do think at the margin also the election will have some impact, and I think depending on who the front runner is on the Democratic side, we'll see.